Hello guys, welcome back to another lovely trading video. In this one we're going to be doing a video on how to kind of use support and resistance and when maybe not to be taking trades or taking smaller size, basically when you're taking on risk that is unnecessary. So this was commented by who kind of wanted to know when you can when you should avoid taking trades, and I thought it was quite a good idea because I don't think I've done one on that before, but can be very helpful, and they're not big things to really learn, they're just a few things just to remember before taking a trade. So we're going to go over Facebook first because this is a stock that has been getting hit quite heavily lately. From its high just a few weeks ago, we are down around 14%. This is off, I guess, a few things. You've got the whistleblower news, you got their services, all of their services like Instagram, WhatsApp, Facebook were all down for around 12 hours or so, and it was the longest they've ever been out, I think, since the financial crisis, or like back in that time, like 08. And so this is kind of a stock that you probably would want to avoid if you're looking for day or swing trades, and we'll go over this now. So this will mainly be around standard deviations and how you can be using these tips with standard deviations, but some will also apply to however you trade. So if you're just trading gap fills and stuff like that, or normal support and resistance, there's still things that you want to be keeping an eye out. So we'll go over one of these first, and that is actually on using gap fills. So for example, looking at Facebook, we can start looking where are any gap fills. We can see that any kind of gaps that have been there have since been filled. So we will look for one that's a bit more recent, that either hasn't been filled yet or it needs to be filled. So we have one here at 364.50. We had another one created at 355.50. And then you can see we kind of created a new one here at $343.25. Now, some of these won't be filled in real time, so these are things I'll do them now, so it's not like a hindsight view. So you're not just seeing it in hindsight, but some of these you'll be able to see them play out in future and see how accurate they play out. So the first thing you want to be looking at is when a stock's going out on news, it's sometimes a bit more risky to take that trade. Obviously, that's because traders tend to react, and or investors tend to do overreaction. So if it's some news, maybe not even that bad, may bring the stock price down further than you would want, and the same thing if you're maybe shorting it and news comes out, it may bring it down or keep going up further than it really should. So that's one thing to be looking an eye out, is if it's moving off a news event. Sometimes it can be safer just to cut size or avoid the trade altogether, because stocks do tend to move swing highs to swing lows even if there is no news. So what you'll tend to see is that, let's say for example on Facebook, where there is a lot of news or bad news as of right now, that taking along would be more risk, where you could go onto something like DraftKings, which is also pulling back at the moment. If we quickly pull up the chart on that, also pulling back at the moment, but there isn't really any bad news around it, so it's a lot safer to take this exact same trade. As you can see, this is coming into the first deviation. It's a lot less risky to take a trade on DKNG than it is on something, say Facebook, where that's also come into the first deviation but has already gone through the other first deviation. So it doesn't really matter, you don't have to force trades on specific stocks. That's kind of the first thing. Is there will always be another stock that has the same setup without the bad news. So it's usually a lot safer just to take one that either doesn't have much news on it, or if there is news, whatever news is kind of less worse. So like obviously Facebook, the news is very public. That's what, even if DraftKings had news around it, it would never be as public as Facebook because it's just not as big as a company. So that's when it can be safer to play the smaller companies as well, just because the news won't be as broad. I mean, the news on Facebook, whether you're a trader or you're in the market or not, you would have heard about it. I mean, your family members, if you ask them, probably have heard about the whistleblowers of Facebook because it's blasted on BBC News, it's blasted on CNN. Whatever country you're in, you probably heard about it, or any let's say first world country probably has heard of it. So that's kind of the first thing. Avoid it if there's bad news. Secondly is how the gap fills will be affected if you're trading off news. So the first thing I always want to be looking at, and we will use Facebook as an example for this, is when you're looking at gap fills, usually I say, let's say for example Facebook had, let's say it had its gap fill here, but it wasn't filled here, just for quite a quick example because I can't see any others. Let's say it was coming down to here, and we would usually say, okay, that's a good long opportunity, the gap's been filled, and then it will probably continue up. in a scenario like this where you do have a lot of bad news, it's a lot more risky to take these kind of trades, because yes, it will encourage the gap to get filled, but there won't be as many buyers as usual to be stepping in to reclaim that level. So that's one thing you probably want to be less you probably want to be looking at the gap fills a bit less when it's kind of news like that, but they can still be good targets. If you are short, still a good area to be looking at profits, and if you are getting to get long, I'm not saying don't get long at those levels, I'm just saying be a bit more cautious. Then the other thing is, obviously you'll have gap fills. If a stock's on bad news, you're going to gap down. As we've seen with Facebook, we've created a number of gaps now. Like all gaps, they tend to get filled, and even if there's bad news, it means either it will have a 1 or 2 day pullback and fill that gap, or you can just wait for the future for when it comes back to fill that. So I mean, it's not like Facebook's probably never going to hit an all-time high. We'll probably see 2, 3, 4 months down the line, it will hit a new all-time high, so these gaps will be getting filled along the way. However, you will see that some of them will get filled in those 1 to 2 day pullbacks. For example, here with Facebook, we gapped down, pulled back, and filled this gap exactly before continuing down. That's one way you can trade these gap fills. As we usually say, we trade the reversal of the gap instead of trading for the move to the gap, because there's no guarantee that it will fill that exact gap on that day. So what we instead do is say, when the gap's filled, okay, a lot of people may be getting swing long just to there to fill the gap, and then they're looking to short or to close that area once the gap's been filled, because then they don't have a price target really to be looking for. So that's usually why we say we're going to trade the reversal of the gap, which would be here, and that's one thing that does trade a lot stronger during bad news. So obviously with Facebook, we're gapping down, pull back, and that they're usually good short opportunities. Yes, they work in any environment, but they're a way you can actually trade them a lot more when there's bad news on a stock. And then obviously if you're trading with the news as well, you are on limited time, because it's waiting until more buying pressure comes in, but you can usually get 2, maybe 3 good trades on it before it reverses. So even if you've got a 1-to-1 risk to reward, you're safe, or you should be quite safe. Now going on to more standard deviations, news is still the big thing, and that's the main thing I kind of want to make kind of like the biggest point is, when there's news, just be careful. I mean, if you don't trade it, if you don't know how to trade news, just don't trade it at all. Look for an alternative, or if you are trading with news, know when it's a safer time to buy. So for example, on Facebook, our first deviation at the time was around say 340 by the time it hit. Now it's at 343, obviously it moves, but whether you want to look at its current price or where it was roughly when it hit, it doesn't make much difference. You can see when it came into its first deviation, that was around $340. You can see it came in, but we never got that strong bounce that we would look for, and you can see instead it gapped down. This is really unsurprising because it's had bad news. When you have bad news, not as many people are going to be in waiting to buy that normal push, because on a normal time, if there's no news, that's just considered a good price. On bad news, or any kind of news, that's considered a risk or higher risk. So that's one thing you want to be looking out for, because when there's high risk, less people are going to be looking to trade it. Long-term investors are going to be a lot less happy to take it at that if they think it's going to continue down, and may try and get in at a lower price. So that's usually the big thing, is wait for it to kind of get some confirmation if there's news related to it. So a lot of the times you'll see is I will buy blindly, I guess you could say, is when it comes into a level, I will buy. Something like Facebook, I don't buy it because currently there's news. So now it's coming to the first deviation on the daily. Again, that's provided another you would consider low risk opportunity, but as there's news surrounding the stock, you would want some more confirmation. So right now, obviously, we're kind of consolidating or kind of just moving within the 2 deviations. If I was to start getting along on Facebook, doesn't really have to be any change in news, but we would want to see a close back above kind of the first deviation. So in this case, around 343, 344. Once we start closing above that, then it shows, okay, people aren't as scared anymore, a bit more buying pressure is coming in. So that would be the key thing I would be looking for if you're looking to get long and or short, depending if it's on the top side, obviously. Is the key thing is waiting more for confirmation. You can buy a bit more blindly, especially if you're using deviations, as long as you have a strategy obviously in place, depending what your strategy is. But if it is part of it is kind of buying a bit more blindly, you're saying when it comes into this level, it's a good buy, we'll buy some at this level. Obviously, if there's news, you want to probably have something else in line, because buying blindly can be a lot more risky, and especially if there's news, stocks gap a lot more. So even if you had a stop loss, let's say we got long on Facebook at this deviation at 340 and we had a stop at, let's say, 337. By the time it opened on the 4th, we obviously gapped down below that. Stops don't work. Well, obviously they can't work if the market's not open, but that means it's already gone past your max risk. So you're taking on risk that you don't want to be taking, and as I said, stocks will gap a lot more on news. So you kind of want it to wait until the news is either calmed down or there's just showing confirmation of upside. So that's kind of the key thing, is if there's news, wait for confirmation, or take smaller size, or just don't trade it at all, find an alternative. So those are really the key things. Then I guess the other thing I'll go over is where should you be looking to place maybe stops and or take profits. So one thing you will notice quite a lot with, especially on deviations, is they'll trade within zones, and you can look at both deviations as a sort of kind of a just support and resistance line, and you want it to kind of touch one to kind of see it as confirmed. So obviously on Facebook we've been coming down, we broke our first deviation and then broke down now to this second deviation. So when would we consider this a break up or break down? For it to consider it a kind of a reversal and it's going to continue up, we want to close above the first deviation, in this case 343. So once you start closing above that level, you can say, okay, this is kind of being confirmed, it's most likely going to continue up, and can also be a good area, let's say if you are long here, locking in maybe a tiny bit of profit just below that, so if it does reverse back down, you can get at the trade break even or when there's more profit. So yeah, that's the key thing to be looking at, is you don't really count it as a reversal. Even let's say you buy here, obviously it was green for multiple hours here, or you could say even if you bought on this day, if we do use a daily chart, which more people probably use, obviously you bought here and then it changed to a green day, you'd be maybe thinking, okay cool, this is now a reversal. It looks more like a bounce until you get that confirmation over that kind of the next key level. So that's kind of the key thing as well, is just waiting for that confirmation, or knowing when it's most likely a reversal. Until then, you kind of want to have a stop at where you see fit. So usually what I will tend to do is look at the first key area that we would want it to break if we're long. So on Facebook example, we want a close above 340, 330 for it to be happy, considered a reversal. So we'd be looking at the price difference between that. So in this case, it's around $14. And then one thing I would usually do for a stop is, on this you can really use the same thing. You can use the whole $14. Some people may use $7. But $14 is usually a price I'm happy with using, just a one-to-one on that, because how I'll usually trade it is get long here, we have our stop now down at, we'll colour these as well so it's clear, we will have our stop down at around $315. What I would always say as well, let's say it's $14, as in this case it takes you down to $315. Usually just put it a tiny bit below, so for example $314.90 or something, just so you don't get stopped on that whole dollar psychological resistance, because that could end up being the bottom. So yeah, we have our, let's say, one-to-one now risk to reward here. We wouldn't necessarily lock in profits here, so we may lock in a tiny bit, but it's more of a zone. If we come into this and test this 343, fail back down, what we may say is, okay cool, we're going to stop out at this 330 if it comes back to test this, because then most likely it's not showing the strongest amount of buying pressure and is more likely to fail than succeed. So that's one way you can look at it, and that's usually how I would look at it. So then you kind of got your one-to-one through there, but not really looking to lock in profits here. Where would I properly be looking to lock in profits? And I use two things usually for price targets. Firstly, deviations. Don't tend to look too much at the half deviations, and instead look at the next full deviation. So for me, that would be statistical mean at $367. So if we're then getting long at 330, we would be looking for kind of a minimum of a $38 profit, which is about a 2.5 to 1 off that alone. And again, we wouldn't lock in all profits there. We'd most likely look to lock in maybe half or a bit over half there. Then we'd be looking for the next price target at 380. And depending on where the stock is looking, where the deviations, because obviously the deviations will move in lifetime. This most likely wouldn't happen in a few days. It would probably take a few weeks for this kind of trade. So the deviations would have moved. So if there's a good price target that looks achievable, that you kind of have to use a bit of your own initiative and your own kind of insight into the stock and where you think that will go. But then you might be like, okay, cool, I can see it going. Let's say this year deviation's at 417. You'll be like, okay, I can see it breaking its all-time high and pushing up that bit higher to 417. But let's say then, even if we only use these two deviations, which wouldn't always be unlikely, say we look in 50% at each area, then we're looking at around $45, $45 in profit per share, and we're only risking $14 at the end of the day. So that's still, you know, above a 3-to-1, which is quite good. So that's the kind of areas I would be looking to take profit and get rid of losers. So that's kind of just a quick insight on where I'd be looking to place stops and taking profits on these kind of trades. And that's why I always say the ones without news are usually the better ones to trade, because on Facebook it could quite easily push back to say 370 within the next week. But it is also quite likely that we gap down on some news, even if it only goes there for 10 minutes. That doesn't matter, because if you've got a set in stone stop, if it comes down to that level, you're getting stopped out. It doesn't matter if it goes down there for even a second, you're probably going to be getting stopped out. So that's why I always prefer using a stock, let's say in this case DKNG, where it's not really moving off news, as it would be a lot more safer and a lot less likely for it to kind of swing down. So for example, let's say we were taking this trade right now, then on DKNG, this is our low risk buy zone. Where is the closest next deviation level? We can see that being at 49 or kind of $50. So we're risking $2 roughly on this trade. We'll get a more precise amount, so 175. Let's say you had your 175 to the downside. You can see it gapped down, didn't touch our stop, reversed, came to this area where we would say, okay, if it starts to break down again, we would probably get out because it's not as likely to reverse. And in this case, that would have been a good decision, because, well, we don't really know if it would be a good decision, but on this kind of trade is one I would have just stopped out on, got out and maybe wait for some more confirmation, because you can see it's kind of just consolidating it in this area. So I would have looked to just get out that trade break even. But you can see obviously our stop never would have been triggered, and you'll be able to see this is being uploaded on Saturday. But going into the new week, would our stop even be triggered, or would it continue upwards? But this is a trade I would have got out of, but it's just showing you where to be placing stops, and kind of where that level is, where if it's struggling to break out of there, where should you be having your stop, or when should you be getting it out. But where would our price target have been on this? Our first kind of key level would be $55 and $56. So if we're getting in at this 48.14, we're risking obviously our 175. We would have had a price target of around $7.50. So obviously, you know, that's a good 4-to-1. So those are the kind of things on how to kind of take your, or where to be looking for price targets, where to be having stops, when not to be taking trades, when to find alternatives. So I kind of hope that was insightful. If you have any more questions, let me know, and that's it. Peace.